Hi everyone, welcome to the channel. Today we're going to be looking at the company PayPal, ticker PYPL. I'm sure many of you have a PayPal account, with some of you using it more than others. The stock has dropped about 40% over the past year, with their margins being compressed along with some other declining data points. But we'll look to see if there is a potential value opportunity. So first we'll look at their financials, then perform a stock valuation, and then at the end of the video, we'll go into computer modeling to forecast the 52-week stock movement. So let's jump right into it. Here in Excel, we're looking at PayPal's financials, and first thing I'll point out is this far right-hand column is actually the trailing 12 months. So taking into account Q1 and Q2 of 2023 and Q3 and Q4 of last year. First thing we're going to look at is this net income and earnings per share row. And we can see for the prior two fiscal years, it has been declining since 2020. And at the end of the prior fiscal year, it was down about 40%. But good news, we do see a little bit of a return for the trailing 12 months. However, though, when we go down a little bit and we look at this book value and free cash flow per share, we can see those are declining now, particularly free cash flow. Last year, they were 5.1 billion, and now trailing 12 months under 3.7 billion. And they haven't been this low since 2018. So this is a drop of about 20% or so from last year to this trailing 12 months. So a concern that's appearing in their stock price. And we spoke about margins in the beginning. Here's a key example, net profit margin. Typically, they've been in that 13 to 20% range, but trailing 12 months, they're under 9%. So almost half of 2022, more than half from 2021. And the last time they were down in these single digits was back in 2013. So these are that margins that are being compressed. Not really a margin here, but free cash flow to sales. Past couple years, it's been on the decline. Back in 2020, 25.5%, 19% in 21, 18.5% last year, and currently trailing 12 months, just under 13%. So another concern that's impacting the stock price. But, it's not all negative. We can see here revenue that's been increasing over the past 10 years. So that's a nice sign. Share count 10 years ago, 1.2 billion, currently 1.16 billion. So down about 5%. And on their most recent earnings call, management did say they are going to look at aggressively buying back shares. So with this lower share count, probably a perfect opportunity for them to do so. So hopefully they're able to take that advantage. And over the next couple of quarters, maybe we'll see that in their share price start ticking up. But let's go down, look at some more data points on the graph, a little easier to see. On the graph, we'll look at the white line, which is revenue per share. And we can see it has gone up and to the right over the past 10 years. Back then in 2013, around $6, and currently around $25. So that is a nice sign, a nice steadily incline. And then book value per share, similar, starting at around that $6, currently probably around $17, $18. Going up and to the right, over the past trailing 12 months, it is slightly down, but still, it has been growing over the past 10 years. Free cash flow per share and earnings per share, you can see here at the bottom, those are the yellow and green lines. Haven't increased as much and actually kind of leveling off over the past couple of years. So would like to see that improve over the next couple of quarters and into the future. But still, it has gone up, just not as dramatically as the revenue and book value per share. Dividends, we know they don't pay dividends. And return on equity, which is the orange line, you can see 10 years ago, it was down around the 10% range, but that has gone up, kind of hovering in the 15% range, a little higher, currently a little lower than 15%, but still higher than what it was 10 years ago. So that is a nice sign. Net profit margin, which is the purple line, which we've discussed already. And we can see here it's dropped off over the past trailing 12 months. And actually, over the past couple of years, it has been on a decline. So that is one area of the concern where those margins are being compressed. And hopefully, they can make these changes with the company to return that to averaging at least over 10%. Now, let's scroll down and look at the valuation for PayPal. All right. So first, I'll point out is I did do a valuation back in March of this year, taking into account the prior fiscal year, and we can see here intrinsic value was $70.55. Margin of safety at 80%, that would have brought it down to $56.44. And that was using a growth rate of 10% and a discount rate of 10%. So the stock is currently trading about $50 and some change. So currently trading below what I evaluated the stock back in March. However, taking into account the trailing 12 months, we can see here now that the intrinsic value actually is lowered to $59.10. And using a margin of safety of 70%, it actually brings that intrinsic value margin of safety to $41.37. And that's using a growth rate of only 7%. So a little more aggressive on the margin of safety and using a lower growth rate. But let's just look at matching that margin of safety at 80% to what I had when I previously valued PayPal. So I'm going to change that and we'll see how it impacts the stock valuation. That brings the intrinsic value margin of safety up to $47.28. So right in that range of where it's trading at $50. So a nice little ballpark. So I could potentially see myself buying in at $50, but most likely if I'm going to actually wait to see if it gets into the 40s. But let's just look at a few other data points we have here. First is return on invested capital. So something I really like seeing is this over 10%. And we can see for most of these time periods, past 3, 5, 10 years, it's been in that 12% range. It's just this past year over year, it's down at 8%. So one of those concerns that we have, but still, going back to the prior years, it's at 12%. And even 8%, yes, it's lower than 10, but still, it's not too far off. And hopefully they're able to tick it back up a few percentage points to get back in that 10% range. Book value growth rate. So we saw on the graph, it was growing, but over the past year, it's actually slightly down. And same thing with earnings per share. It has grown, but just not as much as some of those other data points that we were looking at. Sales growth, we know that their sales has grown over the past 10 years. And, outside of the past year, which is 8.5%, it was averaging, we can see here, over 15%. And then free cash flow per share, we already discussed that. Just not as well as some of those other points we saw, like revenue per share. So this is one area I really like them to improve on is their free cash flow, especially free cash flow per share. So hopefully if they're going to start buying back their share count, we can start seeing that go up. So a little mix here, but one of the more important data points I like here is that return on equity we discussed, which is actually probably the best data point out of all 5. And hopefully they're just able to tick this back up and get back into that 10% range. But let's look at a few other data points before we move on into the computer modeling to forecast the stock movement. PE ratio, you can see at 14, so it is in that value opportunity, not really at that deep value, but still, for an S&P 500 company, 14, not that bad. Long-term debt to free cash flow, under 3, that's what I want to see, so it's right in that ballpark. Share count, we already discussed, it has gone down, so a little more than what I thought it was, so it's actually at 5.4%. And as I mentioned, management's saying they're going to look at aggressively buying back more shares, and at these lower stock prices, it's the perfect opportunity. Net profit margin over the past 10 years, it's averaged at 13. Prior 3 years, actually just under 15%, but we do know trailing 12 months is lower. It was under 9%, so hopefully they can get these this net profit margin back up over that 10% that we've discussed earlier. All right, let's move on, and we'll actually do the computer modeling to forecast the next 52-week stock movement. In the computer modeling software, I already ran the analysis using two methods. First is the M5 rule, which is what we're looking at right now. And we can see here for the previous Monday, October 23rd, the far right-hand column, the stock price closed at $51.49. And the column right next to it is the S&P 500 ETF, which closed at $417.55. The other column is just various other data points that I'm using. But scrolling down, just looking at this real quickly, before we move into Excel, I copied all the data and we'll go into Excel. It's a little easier to look at it on the graph, but just looking at that far right-hand column as I scroll down, it does show the stock ticking up to around $60. But then dropping back down again, getting back into the $50 range out in April of next year, and actually continuing to drop into the 40s and low 40s into June, July, and actually closing out the next 52 weeks in October of 2024 at $32.77. So M5 rule is showing a lot more bearish outlook. And depending how things go in the overall market, I know some people are predicting a downturn. You might see it getting even below the $40 range. So something to consider. But let's move on to random forest to see what that method is predicting. And same thing for this October 23rd with that stock price closing at $51.49. Scrolling down, we can see it is showing an uptick getting into $60 and actually continuing to go up, getting into $70 out in August of next year, and actually in October of next year, closing at $82.11. So random forest, a lot more bullish outlook. But let's look at both of these data in Excel so we can look at everything on the graph a little easier to see. Back in Excel, we're looking at the graph for PayPal. First, the vertical red line represents this prior Monday, October 23rd. The blue line is the stock price. So everything to the left of that vertical red line is the historical stock price, and everything to the right would be the forecasted. But just looking at the history, we can see here, starting back in 2015, and that's about the time PayPal went public, was, I think, middle of 2015 when they got spun off of eBay. And we can see they had this really nice run up for the next couple of years, and then actually going into the pandemic where it jumped up to like $300 a share. But since then, it's dropped and really has been dropping ever since, and now hovering around that $50 range. But let's just jump over to the other tab where we look at all the results from the two methods we use for predicting the stock movement and also taking the average of the two. First prediction we'll look at is that M5 rule that we saw a few moments ago. And as we noted in the computer modeling software, it was just going to show a slight uptick and then a steady decline going out into October of next year, which we can see here drop into that like low $30 range. And this orange line, that just represents the percentage change during this time. And we can see here, the initial outlook for the next probably couple of months is that uptick to getting around $60, which would be about a 15% or so increase, but then steadily dropping and actually declining about 30% from where we are today to get into that $30 range. So a real bearish outlook for the M5 rule. So if it is that big market drop that some are predicting, we could see it getting that low. Moving on to random forest. So we saw this a few moments ago in the computer modeling software. It was more optimistic, and we can see here, starting at $50 from where we are today, going out to the right here, it has that nice uptick and closing out the next 52 weeks in that $80 range. And if this does pan out, we can see this would be about a 45% or so gain from where we are today. So if you have that more optimistic outlook for the next year for this overall stock market, we could see this, this nice recovery for PayPal. And let's move on to the average, just to take that into account. For the average, we know that both M5 and Random Forest had the initial uptick, and we can see that here going up about 15% and then dropping off somewhat, but still closing out the next 52 weeks on a high note at that $57, looks like 50 cent mark, which would be about an 8% gain from where we are today. To recap, yes, PayPal has shown some data point struggles recently, but it is still a strong company and an industry leader in the payment space, which I don't see changing anytime soon. With the stock trading at around $50, I would say that is a fair value, but I would like to buy it if it gets into the $40 to give a larger margin of safety. And since the computer modeling for the M5 rule does show a more bearish outlook, I do feel a $40 market price range is possible in the near term. With a long-term outlook, I think the stock price can potentially have a strong recovery, which we've seen in the random forest method. So I hope you enjoyed this video and got some information out of it. If so, consider subscribing and hope to see you next time. Thanks.